will get us in the right direction. So it will help me to direct my team in the direction that will help the company to become better. The sincere truth is that financial information is not just a set of figures for investors. It's even also for the managers of the business. Because when you look at the financial statement and analyze it correctly, it will help you know whether the business is doing well, whether the processes are efficient or they are not efficient. So as a line manager, it will help me to know whether my process, the process I'm sitting on, is efficient. Beyond that, it will help me to focus on the important things. For example, if I actually do an health check of my financial, of my company, it will help me know what to focus on. For example, what process to focus on. What process I don't need to disturb myself with. What process I need to actually direct resources towards. Analyzing your financial statement will help you know that. Beyond that, it will also help the line managers to focus initiatives that will help the company to become better. As line managers, you are not there to just sign. You are also there to bring innovation, initiatives that will drive and actually help the company to be well. So when I actually understand the financial status of my company, I can better tell the company what to do and how to do it as management or as managers or as line managers. But as the employee, why do I even need to know? Do you know as the employee too, you need to know the financial status or the financial health of your company as an employee. For example, if I actually do the analysis of the financial health of my company and I discover that, oh, these are the figures, and analyze the figures will tell me whether the process that I am involved in is efficient or not. If the process I'm involved in is efficient, I should actually do more so that it can actually be more efficient, continually be more efficient, or continually stay on that efficiency level. But in a situation where that process that I am involved in is not efficient, based on the health check, analysis of the financial statement, analysis of financial information, then I will know what best to do to help the company to rise up to the task of getting to be better at what they are not good at. Remember, the figures you see in the financial statement, they are not from they didn't fall down from heaven. They fell down from the processes. For example, we sold, that was the process. We collected money, that was the process. We did a service as a company, that was the process. We actually had to spend some money to bring in some contracts, marketing, that was the process. If that process is efficient, the financial statement can tell us. So even as an employee, I want to know. And the sincere truth is that if the company is doing so well, and I discover that the process I am involved in is doing so well because I'm doing so much good, then I can even ask the company for a raise. I can say to the company, oh, before I started doing this role, this was the performance level. After I got into this role, the performance level of the company has increased from 50 to 90%. I deserve a raise. Come to think about it, you could be in a company for 20 years, or anybody can be in a company for 10 years, 20 years, and they are not contributing the right quotas. So if you actually can decipher the health status of the company and determine whether it is good or not, and you can show that I am the reason why this company is progressing, then you can ask for a promotion. So even as an employee, I actually want to know the health status of my company. So we are all involved in understanding the health status of our company, whether as the owners or as the managers or even as the employees. We are all involved. Everybody's involved. Taking it a step further, I really, really want to even understand what we're saying. So the sincere truth is that when I actually pick up a financial statement, the financial statement looks like a set of books for some people, investors. But the sincere truth is that the financial statement is how you know what has happened during a period, over a period of time, and as at a period in time. So if it is that report, it's like a report sheet. So you see, when you take your report sheet home, I'm going to take you back to many years ago when you were young. When they give you the report sheet, it shows you how you have done. But when you take the report sheet and get home and give it to your parents will probably also be happy to say, my child has done so well like this. So whether it's the employee or the line manager or the shareholders like your parents were, everybody is interested in how you have done, which is what the financial statement is saying. So let's try to understand what the financial statement is saying. Let's try to get a hand into what the financial statement is saying. So I'm actually going to start. I assume that almost everybody here has some level of understanding of what the financial statement is. So I'm actually just going to do a peripheral thing before we go into the real clubs of today. Remember, the whole essence of this series we are having is, number one, how do I know what is wrong with my company? Number two, how do I prefer solutions? As accountants, your solution is not just to prepare financial statement at the end of the year. No. As an accountant, as a finance person, it is also to contribute to how the company can become better because you understand the figures. So in this series, you would also understand how to actually prefer solutions to problems that you can decipher from the financial data. So number one, we detect what the problems are in a company by analyzing the financial statement. Number two, we also will be able to know how best to suggest solutions and what kind of solutions can we suggest. Number three, we would also look at how we can forecast financial performance to the company, how we can project, and how we can advise management on what to do to achieve those future projections. So it is a holistic thing. It is very holistic to look at the business from like a doctor's perspective. So as an accountant, you are the doctor of the company. So as the doctor of the company, we need to diagnose. So what do we diagnose in most cases? Let us start from the financial statement. The financial statement is a result sheet. It's a result, like the result you take home. So what is inside this result? Let's take a look together. The sincere truth is that there are different users of the financial statement, but the financial statement will not make sense if you cannot, for example, you cannot say, for example, you make so much money this year, 500 million this year, and you look at the figures and you say, oh, this company is doing so well. But if you have not compared it with how you did last year, you won't be able to say whether you have done so well or not. If you have not compared it appropriately with even the costs you have incurred, you cannot say you have done so well, because it's possible a company actually invests 500 million and gets back 505 million. The question is, have you done so well? So the financial statement in its own does not say so much. You now need skills to get the right information from the financial statement. Now that skill is what we are focusing on here. How do we analyze the financial statement to diagnose it, to do a diagnosis and come out to say, this is what should be done? When I see a financial statement, what am I seeing? I'm seeing a set of figures, a set of information talking about how the company has done for a period, where the company is today. Number one, I see a statement that tells me how the company has done over a period in time. For example, January 1 to 31 December, performance, how have we done? I also see another statement that tells me, as at a point in time, what do we even have? Financial position. Then I also get more information about things like, how have we done with cash flow? How did we fund ourselves? And how did we even spend the cash flows? Because the sincere truth is that if we can manage how we fund ourselves and how we spend the cash flows, then we can manage the business better. If we can manage the process that is bringing the performance in, then we can manage what we will get. So when I see the financial statement, that is what I see. It's a storybook telling me how we have done, telling me where we are today, telling me how much cash we have even gotten during the period and how much we have taken out. This is all it tells me. So when I look at the normal financial statement, it is a storybook that is talking to management. It's a storybook that also employees want to read. It's a storybook that the financial institutions that are giving out the leverage, that are giving out loans, want to read. It's the same storybook that suppliers that want to give us stock want to read. It's the same book that advisors, financial advisors for all our investors want to read. It's the same thing that they will put out in journals. Shareholders want to read them. Tax regulatory body wants to read them. The sincere truth is that everybody wants to get a particular kind of information. Everybody is looking for a particular thing in the financial statement. The question is, what are you looking for? As an employee, probably what you're looking out for is, how have we done? If we have done so well, there's bonus. If we have done so well, and it's the process that I'm involved in that has done so well, I can request to say, management, I did so well. How did I do so well? Oh, I am involved in getting, say for example, marketing. Then I actually look at the marketing strength, comparison between revenue and the marketing cost. And I will go to management and say, oh, you gave me small money, I still brought in so much. Don't you think I need actually a promotion? You can ask for what you can ask based on what you have done. As management can actually look at it and say, oh, this is where we are going to in 5 years. What do we need to do to get there between now and then? So it is saying so much thing to different people. But you know what? They have different statements in there. So basically, a normal financial statement will actually include a statement of financial position that is telling us how we have done, where we are as at today. It is also called balance sheet. And you all know, another statement that you have in there in a financial statement is, say, for example, a statement of profit or loss and other comprehensive income. It tells us how we have done over a period. Say, for example, between January 1 and 31 December, how have we done? What profit did we make? And we also have the statement of changes in equity that tells us how we have increased equity. How has shareholders' fund increased? How have we bettered the lives of the owners of the company? And what transactions did the owner of the company do with us as a company during the year? For example, they brought in money as share capital. For example, we gave them bonus issue. For example, they took dividends. For example, there was a gain in a reserve account. That is what we have the statement of changes in equity. Then we also have the statement of cash flows that tells us how did we fund operations and how do we use funds. So all of this is what we actually have in the financial statement. However, in Nigeria, in the annual financial statement, we have more. We have things like 5-year financial statement summary. We have things like value-added statement. We have things like director's reports. We have things like audit opinion. All of those ones added together makes it an annual report. So all this we actually have in the financial statement. But remember that for us to have a financial statement, it all started from transactions. So if we actually want to get an health check of the company, remember that transactions cumulated into general ledger. So for example, we sold goods or we rendered services. That transaction was entered into our books. Transaction enters into general ledger. At the end of a period, we ran the trial balance. What is the essence of the trial balance? It's just a summary of all of the things in the general ledger to determine whether it balances. Then we now take that trial balance and now put it together in an organized format that we call a financial statement. Whether it's management reports or statutory reports, annual, quarterly, all of this now becomes a statement. Now, remember, everything started from transaction. What determines whether the company is doing so well or not is whether the right transactions are coming in. So that means if there's a relationship between transaction and the financial statement I'm looking at, if there's a relationship, that means I can also use that to determine the kind of transactions that will help us to achieve the kind of statement we want. By looking at the statement, I can also see whether we are going into the right transactions or not. Now, that is what we are going to learn today. How do I know whether I'm actually doing that? Let's just do some little accounting 101. We know this, that the equation in our statement of profit or loss is that revenue plus gain plus other income minus expense and losses is what will give us the profit for the year. So you see, all the money we bring in, all the gains from whether it's we invested in Zenith Bank and the share price has gone high. Other income, like we sold the company asset that we don't need again. Expenses that we have to incur so that we can actually do business. Losses in a situation where we invest in treasury bill or we invest in one other bond and something happens and the prices fell. All of the total is the profit we have for the year. But if I may shock you, the revenue that you have in that statement of profit or loss and other comprehensive income is all coming from the transactions you have done. So that means if we actually have a lot of transactions, probably our revenue would go up. If we are charging the right amount of price or the right price, the correct pricing mix, probably the revenue would have gone up. If, for example, we are even selling to the right sector of people, probably the revenue would have gone up. So, or for example, if it's expenses, whether we're even spending so much to get the revenue, whether rather than spending so much, we can also find another way of spending the money that is not up to that and we'll still make the same revenue. For example, you could decide to actually say, you know what, in the afternoon, everybody, all the employees actually get lunch and they get lunch from Chinese restaurant. So we look at the total expense and we say, oh, it is for the year, it is 100 million. However, you look at the revenue, then you're able to make a decision to say, okay, what about the TFC by the office? Why not that we actually do TFC rather than going to the island to actually get Chinese for everybody? So it is the decisions that determine the figures we see. Who makes the decisions? Management. Who can advise management on the right decisions to take? You, the finance person, the accountant, the employee, the line manager, and also management themselves. You can advise management. When you look at the equation, which you all know in the statement of financial position, the equation is telling us that liabilities plus equity is equal to assets. What does that mean to a layman? I need to fund assets. Why? It is the assets that will give us income, revenue. If we don't build up assets, there's no revenue coming back. How can we fund the assets? We can bring money out from our pocket as shareholders, or we can just go and get money from the bank, or tell the creditor to give us the thing and we'll pay him back. Liability. Those are the two ways that we actually fund the running of the business. So if we actually want to earn more, concentrate on the assets. Concentrate on building the assets. And you will be able to actually have a better one in them. You know all this already. Your normal statement of financial position, like I said, you will get all of those things that you own, that the company owns. So you will get things like PPE, investment securities, loans that you have given out, trade receivables, inventory, and on and on and on. In your P&L, you will get things that will talk like revenue, interest income, interest expense, fees, expenses, other income, other expenses, and all of those kind of things. You have them all in your statement of other comprehensive income. Like I said, it will tell us how we have done within a particular period. Taking it a step further, in the statement of changes in equity, Like I said, what you would have there is all of the components of equity. What do I mean by all of the components of equity? Share capital, share premium, reserves, movements in reserve during the period, profit for the year that is going into retained earnings, and also the retained earnings balance. And that is all that you will have in that particular statement. I need to go to the real crux of what we are doing. And in the cash flows, you know cash flows already. The statement of cash flows is just holding for us and explaining to us how we have sourced for funds and how we have utilized funds. The way I tell people is a reconciliation account, is a movement account. Is a movement between opening balance of cash and cash equivalent and the closing balance of cash and cash equivalent. The question is now, where did we get money from? Oh, we got cash from operating activities. We got cash from financing activities. We got cash from investing activities. How did we spend the cash? We spent the cash in operating activities. We spent money to make money. We spent the cash in financing activities. We spent the cash in investing activities that's interest income, interest expense and all that. So it's a movement of what cash and cash equivalent do we have at the beginning of the year and what cash and cash equivalent do we have at the end of the year. That is the movement. Let's now go straight into this financial statement we're even talking about. What is the framework in this country? Then after that, we'll now go and look at how do we diagnose this statement? How do we know what is wrong? How? We'll go into that shortly. Now, in Nigeria, we use International Financial Reporting Standards. And it's a set of people that they call them International Accounting Standards Board. Those are the guys that actually dish out the standards. And they have been dishing out the standards for a couple of years. So now Nigeria has come on to International Financial Reporting Standards. And they told us, the regulators, they told us that all the public PLCs and significant public interest entities, 2012, everybody has gone. 2013, other public interest entities. 2014, all the SMEs. So effectively, everybody is using IFRS in Nigeria. Is an assumption. Because if you now ask the supermarket that is on your street, I don't know whether they are using it. However, the assumption based on the regulators or based on every other thing we should have is that everybody is on what? IFRS. Now, this IFRS we are talking about now, like I said, is issued by International Accounting Standards Board. It's in over 130 countries. And basically, when I am talking about IFRS, I am talking about all of the IAS standards that are applicable, all of the IFRS standards that are applicable, all of the IFRIC standards. IFRIC standards are interpretations for IFRS. All the SIC standards are interpretations for IAS. And all of the framework, everything together is what they call IFRS. Now, so when I ask the question, are you IFRS compliant? That means that you know every standard that should have been applied in your company and you are applying them. At that point, you are compliant. And the very funny thing is that the standard itself is dynamic. It changes. So we know the one that will change by next year. They are preparing it already. Some changed last year. Some changed last 2 years. So you cannot be an accountant in the past. The mere fact that you actually have a first class BSc accounting and master's BSc, master's accounting, the sincerity is that the guidelines will change. So that means that continuous improvement is a requirement. You cannot say I knew it yesterday because it will change today. It is actually changing already. And you can actually see the improvements that are actually being made. For the people in the insurance sector, they know that they are expecting a major boom, a major change. And for them, IFRS 17, they are waiting for that major change and they are trying to understand it. So when I talk IFRS, I talk all of that. And the very funny thing is that you are all involved. Let me give you an instance. You know, I always give this scenario so that people will actually understand what I mean. Before now, you know, when we're actually doing financial statements, then we always carry the green book, NASB. Now there's no green book again. Remember, for all of those people that use NASB then, remember that it is only when you want to prepare financial statement you carry NASB, the green book. But now, the very funny thing is that IFRS is not about reporting alone. IFRS is also about the transactions. For example, any IFRS standard that you pick up, it will talk about initial recognition. Initial recognition means what you will do at the date you are entering into that transaction. For example, when you sell a particular thing, what should you do? When you buy an instrument, what should you do? When you give a loan, what should you do? When you give when you actually are selling a particular ware, what should you do? When you are buying inventory, what should you do? So it tells you that IFRS is also about transaction. So IFRS is also the standard that talks about record keeping. So if you have the opinion that it is all about financial reporting at the end of the year, that means at the end of each year, you will have backlog of things you need to do if you did not do the correct thing when you are initially recognizing. So IFRS is also about bookkeeping, data maintenance, and systems. IFRS is about people and performance. For example, if you don't understand what you need to do, at the end of each year, your auditor will be writing you. So I actually saw a management report once. You can see a management report to clients that will be as much as 200 pages from auditors. If your system, your data, your people don't even understand what they are supposed to do, auditors will write a very long management letter saying that the process is not efficient, saying that your process is not compliant with IFRS, saying that, the people don't know what they are doing. I always use this example to clarify what I mean. So some years ago, I was actually doing this client. I always use this example so that you get it. There was a smaller company that was an all-age company. And there was a bigger company that was into, alcoholic, non-alcoholic beverages. So the smaller company came to the bigger company and told them, can we just lease all our vehicles, all our articulated vehicles to you? Then the bigger company said, yes, now, we will lease everything from you. So all the vehicles in the smaller company were leased to the bigger company. And because the smaller company did not want the bigger company to go away, they said, you know what? Whenever we want to make any key decision in our company, we will always get your permission because all our vehicles are with you. So we will even always get your permission. 2, they also said that the COO, Chief Operating Officer, in the smaller company, they agreed. They said, our COO will come from you, the bigger company. Your staff will be our COO here. Now, in that agreement, the name on top of it was lease agreement for articulated vehicles. The MD of the smaller company signed it. In the bigger company, they signed it too. And from the perspective of what the two of them were doing, the two companies, they thought it was lease. But when we applied the guidance of IFRS, it was the loss of company. It was effectively the sale of control, the loss of control to the bigger company. And the guidance under IFRS is that if you have control of another company, you must consolidate it. So effectively, the bigger company started consolidating the smaller company. Why? Not because the MD wanted to sell his company, but because the MD did not understand the implication of what was inside what he was signing. He signed his company out as a lease agreement. What does that tell me? Governance and oversight must even understand the financial statement beyond the dividends they are looking for. You know, in most cases, the shareholders are just concerned about the dividends. But you see, when they sign anything that would even cause more problem than the dividends, they also need to know. And that is where IFRS also has an impact on governance and oversight, apart from even on the people within the company. It is a language of business. Now, going straight forward really into how do I even understand? How do I understand what is going on in our company. The sincere truth is that as the accountant, you probably don't have information. Let's even assume that it's like a big conglomerate. It's a group of companies. You probably might not have all the information of what is going on in each of the units. But your financial statement can tell you a lot. How do I mine that data? How do I mine the information from the financial statement? And that is where I come to financial performance and interpretation. Financial performance and interpretation. Now, we're going to spend some little time together here on looking at the financial performance and interpretation. How do I understand what is going on in the financial statement? Now, you see, one traditional method we use is financial ratios. And you see, financial ratios is actually a very powerful tool. Why did I say that? For example, there's a relationship between everything. For example, there's a relationship between how much sales we did and the amount that will be inside revenue. If we sold more, our revenue will increase. If we did not sell as much, our revenue might not increase. There's also a relationship between the cost of sale and that revenue. The assumption is that cost of sale actually flow the way sale flow. So in a situation where cost of sale is increasing, revenue is not increasing, there's a problem. Is either management is not efficient, or the process that is tracking that cost of sales is fraudulent, or the process that is tracking that cost of sales is not efficient enough to ensure that revenue is increasing. There is a relationship between each of the data that you have in the financial statement. If that relationship is well understood, we can tell what is going on. It's like a production line. When we have actually knitted the dough, after knitting the dough, they will now cut it into pieces. They will put it inside the oven. Then it becomes biscuit. Now, if you did not knit as many dough, you will not get as many biscuits. So you can generalize or rationalize and say, the reason why we have not too many biscuits is because we did not use too many what? Flour. So in a situation where you use a lot of flour and you got smaller number of doughs, that means there was wastage. So what tells us that? The relationship between the number of the biscuits we got and the amount of flour that we put in. Input and output. What does it tell us? It tells us that the process is either efficient or inefficient. Ratio is the one that helps us to do that. So ratios will allow us to understand the interaction between items of the financial statement that represent processes. Now, to mark it again, transaction entered into general ledger into trial balance into financial statement. What drives transaction? Processes. If what drives transaction is processes, then I can say, if I have compared within some period my figures, I can see whether that process is getting better or not getting better. What helps me to do that? Ratio analysis. So we are going to look at a lot of ratios. And we are going to, I'm not just teaching you ratios, I'm teaching you what it means. I'm teaching you what it means so that you will be able to advise management. I'm not teaching you ratios in itself. You know some of these ratios already. But how do I know what it is really saying? That is what I want us to talk about. Now I'm going to take a pause and ask you, because now I want to know whether I've been talking to myself or whether everybody I'm seeing here is system or everybody I'm seeing here is human being. Any questions at this point?
No questions from my end.
No questions. I cannot call names because there are so many people here. So any other person, any questions at this point?
No questions, sir.
Correct. So I know that I'm not the only one here. I can see 83 people, so I'm not the only one really. So we are quite. Now, let's take it a step further. When you are actually doing a ratio analysis, now I always tell people, when you are doing a ratio analysis, okay, Sonny Baba, you raised up your hand. You can actually ask your question. Sani Baba, you can ask your question, please.
I think the hand has been up for a while.
Oh,
I'm not
okay.
sure he wants to ask question.
Okay, no problem then. Okay, so let's take it a step further then. Now, when you're actually doing an analysis of your financial statement, I always tell people, you will actually do your analysis vertically and horizontally and diagonally. So when you are doing analysis of financial statements, so that you will understand what has happened. For example, how do you know whether your son or your daughter is getting better in school? What would you do? You will take their report last year, report 2 years ago, report this year, and say, are you getting better or worse? So if you see a child that was always scoring 50% before, second year is scored 60, next year is scored 80, and you compare it with another person that has always been scoring 79, 78, 80, 69, 79. Now, if you look at the two of them, you will discover that one is getting better and one is moving diagonally. One is moving zigzag. So the one moving zigzag, you know that he needs attention. How did you know? You compared period over period. You compared his own result, period over period. So the first kind of analysis you do is across periods. You are doing what? Across periods. You are doing it horizontal, across period for the same person. But you can do another analysis. You can now do analysis between your own son that is scoring 70, 70, 70, and what every other person, the average of what every other person in his class is scoring. Let's assume that every other person in this class is scoring 90, 98, 98, 90, 98. So the average of the class is, say, for example, 97. Even if your son is now scoring 70, is he performing well? So if you look at it very well, you also need to compare with the industry average. So when we are doing an analysis of our company, we are also doing analysis with the what? Industry average. The third analysis I will also talk about is analysis with your peers. You know, when you are doing an industry average, there's a possibility that within the industry, there are some that are better than you. There are some, for example, you are doing an industry average and you are comparing with companies in the United States. You are comparing with companies in the UK. The sincere truth is this. It might not actually, you might actually discover that you are not comparing apple with apple. You are comparing apple with orange. So you can also do a direct comparison with your direct competitor. You look at the statement of your competitor and compare and say, how have we done? Are we better than company ABC? So three kinds of analysis: across periods, internally. You can also do against your competitor. You can also do against the industry average. And the last one you can do is against the budget or against the financial projection. For example, we are hearing Vision 2000. All of a sudden, they say it's Vision 2020. If the thing keeps changing. Now, I don't know which vision we are having again in Nigeria. But the most important thing is that at every point in time, I don't think we're checking our performance against those visions. Another way you can decipher whether the company is doing well is check it against the budget. Check it against the projection that the company has for 3 years, for 5 years, and we'll begin to see whether we are moving in the right direction. Now, all of this kind of analysis we are talking about, they are all wonderful analysis. But I'm going to talk about some traditional analysis that you have done in school. I'm going to talk about analysis to determine whether we are profitable, profitability analysis, whether we are liquid enough, whether we are efficient in the business. You know, sometimes efficiency actually drives a lot. So you can be doing so much work and not getting money for what you are doing. To sort that one out, you might actually need to tinker a little bit with the process. Another analysis we'll look at is the financial position, gearing. How do we know whether we are appropriately geared? We are going to start with the profitability analysis. Now, like I said, I'm not teaching you the ratios because I assume you knew that a long time ago. I'm only going to teach you how to apply it appropriately and what it means. That is what I want to talk about. Now, let's start with a very simple one that you know. Say, for example, the gross profit margin. Now, the gross profit margin is what everybody here knows. And it is measured as gross profit divided by the revenue. However, what does it really say? If a company has a good gross profit margin, increased gross profit margin, you say the company is actually doing so well. So when you see a company that has a gross profit margin that is increasing year on year, period on period, you will say, the company's gross profit margin is increasing, which is good. However, what does it mean? What does it mean? Now, when you look at the gross profit, what is inside there is basically gross profit divided by revenue. What is inside gross profit? It is revenue minus cost, direct cost, cost of sale. The assumption is that if the gross profit margin is increasing, it means management is efficient enough in managing direct costs. Now, mark my words, management is efficient in managing direct costs. So if you see management is saying, okay, we made 500 million, but the cost of making 500 million is 499 million direct cost. It means that probably management has not charged the right price for the sales on the revenue. It could mean that probably management has not done the correct pricing mix and product mix. For example, let us assume that we produce biscuits. In Elisha, they don't eat a lot of the shortbread. They eat more of the Paco biscuit. However, in the production plant, management gave an instruction that make the same unit of Paco biscuit as shortbread. Distribute to each state exactly the same number of products. When they have distributed the number of products to them, they will discover that the one in Elisha, because they don't really eat so much of shortbread, is the Paco biscuit they eat. They will discover that they will have a lot of inventory of shortbread. Paco biscuit will be moving. But remember that if it is not sold, where will it be? It will be inside inventory, not inside revenue. Cost of sales will still be there. And remember, cost of sales will continue to increase as you are trying to bring up your sales. Even for some company, if they borrow money to make those biscuits, they borrow money to buy the machine, they will charge the interest income inside direct cost, inside cost of sales. And because they are repaying back that interest expense, their cost of sales will be increasing. However, revenue is not increasing. Why? Because management did not make the right decision to determine the number of products that should go to Elisha and which kind of products should go to Elisha. So to an extent, management is the one that is not making the correct decision. Though they are moving the product to Elisha, but they are not moving the right product to Elisha. So your gross profit margin might be small because management does not know the optimum amount of product to move to each location. Your gross profit margin too might reduce in a situation where management does not even know the right amount of money to charge. For example, if you go to a hotel, you want to buy a bottle of Coke, the same Coca-Cola you are paying, for example, 500 naira. You enter traffic, you want to buy Coca-Cola, you are paying 100 naira. Is it not the same product? Yes. But you see, in a hotel, people will not even have change. So the 100 naira cannot be the money. 1,000 naira should be the money. The same product, different pricing. Where would I know whether management is making that right decision? From the financial statement. So in a situation where the gross profit margin is increasing, it could be as a result of the fact that management understands pricing strategy. So in a situation where management does not understand it, they will take it to a hotel, charge 100 naira. They will take it to Elisha, charge 100 naira. The sincere truth is that the gross profit margin will be reduced. But because some companies understand that gimmick, what would they do? They will take it. That is why when you enter into ShopRite, you will discover that even the companies themselves, their representatives are there. And they are trying to market their products. Why? If their products sell, the company becomes what? Better. So if you look at it, it's as if there's a lot of forward integration. Because now, Friesland, if you go to ShopRite, you will find Friesland staff there. But their work is to do production. But you see, for them to actually bring in the money, they need to sell. And that is where their gross profit margin shows. So you see, when gross profit margin is increasing, it actually shows whether management has the right acumen to manage direct cost. What is direct cost? The cost to produce. Whether management is able to manage direct cost and increase revenue. So where you see the gross profit margin increasing, it means that management knows how to shop the pricing correctly. Management knows how to distribute the right product to the right place that is selling. It means management knows how to actually reduce the cost. For example, how can I reduce the cost of on interest expense? I go to the bank and tell them, I beg, reduce this interest rate, renegotiate interest. So all this is what contributes into what you're actually seeing inside the gross profit margin. So when I see a gross profit margin reducing, it will raise an understanding to say, oh, check this particular thing. When I see the gross profit margin increasing, the next thing I'll go and check is that, oh, has the sales price dropped? Or is it that the cost of sales increased and the sales price remained? No management will maintain the same sales price when the cost is increasing, only if you actually have rebates from the government. For example, that was why recently we heard that the landing cost of fuel has increased to 170 naira. And see, the people already, the filling stations, they will not be stupid enough to be selling it at 140 when government will not pay them back their money. So gross profit margin shows us those kind of information. 2, let's go to the net profit margin. Now, when you are comparing also gross profit margin, before I move away from here, like I said, you do 4 kinds of analysis. Analysis year on year, period on period, to determine whether we are doing better or our gross profit margin is increasing. Then we do a comparison with the industry average. Then we do a comparison with a direct competitor that is like us. Then we do a comparison with budgets or the financial projections that we actually have. We can do any of these analysis to determine whether we are doing so well. Now, that is actually the gross profit margin. If it is increasing period over period, I5, you have done a great job. Management is doing a great job. But also be very careful. There could be some, let me teach you how you can do some whatever. You see, for example, you will see some companies, you know, when inventory is moving out, for example, they did a valuation of inventory at the end of the year. When you do a valuation of inventory and there is a devaluation, what many companies will do is that they will charge that devaluation to cost of sales. The sincere truth is that it is not cost of sales because we did not sell anything. Is that the stock or the inventory got spoiled? If it got spoiled, it shows that management is storing inventory they don't need, and it is wastage. It is supposed to go to P&L. But many companies, that particular wastage, it always goes to cost of sales. So you will be seeing cost of sales increase. So when you see that gross profit margin is reducing, check. It is possible that there was a valuation of those stock, and those stock reduced in value. They now charge it to cost of sales. So all this talks about how management has been efficient in managing direct costs. Going to net profit margin. What the net profit margin tells us basically is that how efficient is management over one period. You know, the net profit margin talks about the decisions you have made this year. It talks about decisions on direct costs, decisions on indirect costs, all that you have made in a particular period. That is what it measures. And the net profit margin is measured as net profit divided by revenue. Now, what does it tell us? Now, mark this one thing. Your net profit margin is showing whether the business process in the company is efficiently managed or not. What do I mean? The business process that produces revenue is called selling activities. The department in many companies that manages it is marketing department. If there's no revenue, it could be because marketing department is actually not able to get in the amount they are supposed to actually get in. So what should management do? Management should touch on the marketing department and the selling process. So net profit margin is looking at the whole business process for a particular year. If the net profit margin increases period over period, that means management is doing a great job with managing the business process in the company. But if I check one period to another period and I discover that the net profit margin is dropping, there's a possibility that some of the business processes are inefficient. So when you see a company that is making a loss, it is the business process that is causing the loss. Remember, input plus process will give us output. The output is the net profit. Net profit margin is a ratio that talks about the relationship between input and output. If that relationship is telling us that we have not done so well, it means within the process, the people and the process, there's something that needs to be worked on. So, all of the business processes in the company, what tells us whether management has done efficiently well and effectively well is the net profit margin. When you are looking at the net profit margin, for example, last year, we actually used, in the factory, we were using people to do packaging of the biscuits. All of a sudden, a new management came up and said, no, now we are going to be using machine. Human beings can package 20,000 units per day. All of a sudden, we got robots, and now they can package 100,000 per hour. What happens? Now, you will discover that that period and subsequent periods, revenue might shoot up. Cost of sales might drop down in subsequent periods. Why? Because the direct and the indirect cost of running that business has what? Reduced. How did it reduce? We invested in one asset and we did not have to pay recurrent costs as much any longer. What does that tell us? Decisions. So when I see a better net profit margin, it could mean that management is making better decisions. If if management is making better decisions, it means that the business process is more efficient. So that is what the net profit margin measures. However, we need to also look deeper. When the mere fact that you actually see that it was 30% this year, it became 38% next year, or it became 38% this year, last year was 30%, and we say management is doing well, net profit margin has increased. Please check. It's possible that net profit margin increased because there was a significant investment in advertising. For example, we just launched a new product. We launched the new product in December. And that new product, we had to spend so much money on advertising. And as a result of that, because it's a new product, we still continued advertising on the old products. So at the end of the year, you now discover that, the increase in net profit margin is small. That does not mean management has done well. Check whether there's a new thing that they did just before year end. Because it's possible that was what chopped into what you actually add in the net profit margin. The next one, however, like I said, net profit margin talks about what happened in 1 year alone. I won't lie to you, I think that particular one is not efficient enough. Why did I say so? See, companies make investment for the future. For example, in the illustration I gave that we invested in robots. Remember that when we are investing in the robots, it's possible that it took us 1 year to bring in all the robotic arms, install all the robotic arms, do all of the manufacturing plans, do all of the manufacturing, the factory. It's possible it took like 1 year, and we invested so much money. Now, when you look at your net profit margin, in those years where you did investment, it might look as if, you did not do so well, because depreciation will start coming in, especially when you start using it in the first year. But you see, the very funny thing there is that net profit margin only looks at the decisions that are actually impacting transactions during the year. A better one or a better ratio is what we call return on capital employed. Because you see, return on capital employed looks beyond what you did that year. Net profit margin is like the one that they use more in Nigeria. Why? Especially in politics. You will see politicians, they will want to do the project that they can finish in their 4 years. Why? Because you can say they were the ones that did it. But in better economies, it will be, let us look at the total impact of all of the investments that we have made ever since this company started, and how much we are getting back from it. That is what return on capital employed does. What does it measure? It measures for every 1 naira that management is investing, how much profit did we make? For every 1 naira, the shareholders, the owners of the company, equity that we have, capital that is employed, how much did we make back in terms of profit? So it looks at not just the money that is spent this year, not just the decisions that was made this year, but the decisions that have been made cumulatively from the past. That is what return on capital employed measures. If, for example, you have been having a bad business manager for many years, it is possible that in a new year, when you get a good business manager, your net profit margin will increase, but your return on capital employed will not increase. Why? Because cumulatively, your return on capital employed will be taken from what has happened in the past. So if you have had a retained earnings that is negative, you will discover that what you would have in return on capital employed can even be a negative. What is return on capital employed measuring? Is measuring how efficient is the business. And when he's looking at the business is not just the decisions of management that year alone. It is looking at all of the decisions of management cumulatively till now. For example, how much naira, how much money did we make from 1 naira that we are investing as capital employed? To calculate capital employed is calculated as profit before interest and tax over capital employed. And you see, capital employed is whether it is equity plus your interest-bearing liabilities. How did you finance the business? So capital employed is which capital did you employ? Is it the capital that belongs to the shareholder or you went to borrow money from outside? All of the capital that you employed, how much money did we get back from it? If it is low, that means that we are probably not doing a good job. If it is negative, it means that for every naira that you are spending, you are making a loss. If it is zero, it means that as you are spending it, the thing is going away. It's not coming back at all. However, if it is growing period over period, that means you are doing a good job. Management is doing a good job. So these are some of them. And if I go to, like, for example, in the banking world, we have the net interest margin. You see, in the banking world or financial sector, the net interest margin, for example, those deposit taking and non-deposit taking finance houses, microfinance banks, and the commercial banks. How do we measure it? The net profit margin. It is our net income margin. The net income margin is measured as interest income minus interest expense plus all of the loan fees. All of the loan fees, all the fees that you are collecting, add everything together. Divided by the interest income. Now, why is it calculated? We want to know the gap. What is the gap between the source of income or the source of fund, which is deposit, interest expense? The cost of the source of fund is interest expense. The benefit from the asset that we have is interest income. So interest income, interest expense, and any other fee that comes from the income, from the loan, all added together, divided by the interest income, will give us how much we have been able to do. And what does it measure? It measures the net benefit from all the business you are doing. In a situation where you are collecting funds as deposits or as borrowings, you are collecting it at 10% and you are giving loan at 11%, you will discover that your net interest margin will be very small or even zero. So what does that measure? It measures how management is able to negotiate, how the people in investment are able to actually get a better margin, how the people in loans are able to get a better margin, how the people that are actually collecting the deposit, they're able to negotiate a lower margin. And as a result of that, bring more to the business. So that is what the net interest margin measures. Better year on year is good. Better than your industry average, good. Better than your competitor, good. Worse off year on year, bad. And on and on. Taking it a step further, let me try to actually talk about some efficiency ratios. How do I know whether your business is efficient? Now, I will know that if management uses resources to run the business efficiently. How do I know? Now, that is what the working capital measures. Your working capital is the capital that you use to work. So it's the capital that is rolling like a cycle. So if I understand the working capital cycle, then I can understand how to be more efficient in the business. How do I know that I'm efficient? If the working capital cycle is short, it could mean that I'm more efficient. If it is long, that means it takes me more time to make money from my capital. If the time is short, it means I am able to make more money from the capital that I'm using. Remember, If, for example, the working capital cycle of a business is 520 days, the meaning of that is that for every one business that they do, they are not able to make money for 1 year until 520 something days. I don't think you want to invest in such a business. So the working capital cycle is the one that tells me whether I am efficient as a business. It reflects the ability and efficiency of the organization. If it is short, we are good. If it is long, we are not so good. How do I measure it? Your inventory days plus receivable days minus payable days is your working capital cycle. So let's talk about them one by one. Your inventory days. Now look at it. That your inventory days is the period it takes you to have what to sell and the period when you sell it. The period between the time when you stock up what you want to sell and the period when you actually sold. That is the inventory days. If the period is short, it means that you manufactured it today and you sold it today. Very good. With that, you can collect the money that you collected back sharp and use it to do another business. And remember, let's assume that you bought it at 5 naira. You sold it at 10 naira. You are collecting back 10 naira immediately and reinvesting it. If you do a cumulative if you do compounding, you will discover that before 365 days, you would have made thousands. But in a situation where you bought the stock today, it took you 2 months to sell. You would also discover that within a year, you might not be able to make as much money. Hence, it is saying that you are not efficient at what you are doing. So inventory days measures the period between when we got in the stock and when we sold it. Now, let me take you to a service-oriented company. At what point, what is the period between when we have what to sell and it's sold? The period between we have what we sell and we sold, that is the period that the inventory days measure. Taking it a step further, what is the receivable days? Remember, it's possible that you sold, but you did not collect the money. So we sold it, but the customer said they will pay us later. The receivable days is the number of days between when we sold and when we collected the money from the sale. Now, an efficient business will always collect the money almost immediately. If it is long before you collect the money, you will not have money to do business. You would have to go and borrow money from the bank. If you borrow money from the bank, and you will now discover that the cost of fund is even higher than anything you can make from the business, then that now becomes a problem. So your receivable days, which is the period between when you sold and when you collected money from what you sold, that is your receivable days. Now, the payable days is the period between when the person that sold you the inventory that you are selling, the period between when they gave it to you and when you paid for it. The assumption is that if they gave it to you and you paid for it immediately, the problem with that is that if the number of days that it takes for you to pay them is shorter than the number of days you are collecting your money, you are making a loss. For example, inventory days is 5 days. Receivable days is 4 days. Your payable days is 1 day. It means that your working capital cycle is 5 plus 4 minus 1, which will give you 8. But in a situation where your inventory days is 5 days, receivable days is 4 days, and your payable days is 8 days, your working capital cycle will be 1 day. What is the meaning of that? It means that you delay payment, use the money to run another business, and you are able to use it to increase the benefit on the working capital. Hence, your working capital cycle becomes what? Slim. And when your working capital cycle is slim, it means that the business is efficient. When your working capital cycle is slim, it means that your business is what? Efficient. So whenever you want to know whether your company is efficient, whether the business processes are efficient, check the working capital cycle. Check the working capital cycle. So let's go and check how we calculate this working capital cycle. Let's check how we calculate the working capital cycle. The first one, inventory days. Inventory days, like I mentioned, is inventory divided by cost of sales times 365 days. The whole idea is that we want to have a short inventory days. We don't want to put our stock too much on the in the shop. We want to sell sharp. If you don't sell on time, there's a higher probability of wastage, of obsolescence, higher probability of the fact that it could get spoiled. And you would also be incurring more cost for eating, for cooling, for warehousing, for employee costs. So at every point in time, to ensure efficiency, you want to reduce the inventory days. The cost of having big inventory, longer inventory days is higher. So you want to drive it down. 2, we spoke about the receivable days. Receivable days is measured as trade receivables divided by your sales times 365. What does it tell us? It tells us the number of days it takes to collect our money back. So if we sell something to Mr. A, how many days does it take us on the average to collect our money back? That is what it's telling us. If we don't collect our money back on time, for example, let us assume that we borrowed money to do the business. If we don't collect the money on time, what will happen? It means that you will be paying more interest charges. It also means that we will be incurring so much cost, and when we are actually being paid back, we would have actually paid more cost, more than the amount that we were expecting. It's like you do a business and you're expecting 100 million. So you employed plenty people. All of a sudden, they didn't pay you month 1, month 2, month 3, month 4, month 5, then month 35, and you are still paying all of the employees. By month 36, they now paid you. When they pay you, you will clear the backlog of the 36 months. However, your projection was that the whole business will be done in 3 months. What does that tell you? It tells you that the shorter the receivable period, the better for the business. If not, you will be incurring the costs that are higher than the expectation of the business. So your receivable days tells us that. Now, for like a company where you actually have, so somebody, you raised up your hand. Do you have a question? I just wanted to run through this, then we go to the practical. So we'll actually use a financial statement, a real financial statement to actually want. Somebody raised up his hand. Do you have a question? If you have a question, you can ask your question, please. Any questions? I think, okay. Okay, so somebody is saying I should repeat the ratio for inventory days and payable days. Okay, so I said inventory days, like I said inventory days is the number of days it takes us between when we got the inventory in and when we sold it. So it's the number of the holding days. It's the number of days we are holding it for. So it is calculated as your inventory divided by cost of sales. So it's the number of days between when we brought it in and when we sold it. Payable days, I will get to that now. Now, payable days is now the number of days between when the creditor that sold the thing to us, between that number of days when they sold it to us and when we paid them back. Between when they sold it to us and when we paid them back. Remember that it should be the money that we are collecting from the sales that we are using to pay them. So if you pay them earlier than when you collect the money, that means that you need to source for another fund to pay them, which you would have to pay a charge on. So what you always want to do is increase the payable days, reduce the receivable days and the inventory days. Always ensure that you have a slim working capital cycle at every point in time. Now, for all the companies that are like banks, finance houses, you can also measure efficiency with your non-performing loan. So non-performing loan divided by the total loan tells us how efficient your process is as it pertains to loan, management of loan. So if you have a very, very high volume of non-performing loan, what does it say? It says that you are not doing a good job with your job. Because the work of a bank is to do what? Is to give loans, credit. If you are managing your credit well, then non-performing loan will be smaller because you would have done your risk assessment and you will be giving money to the people that can pay you back. If your non-performing loan is very high, it means that you are giving loan to people that are not good. Meaning of that is that management has not put in enough process to ensure that we are doing business with the right people. So that is for the, okay, somebody is asking another question. Oh, okay. So somebody said, I didn't get the receivable days. Receivable days is measured as the trade receivables or the receivables divided by your sales. Receivable divided by your sales. What is it measuring? Number of days it takes you to collect money from the goods you have sold. And what you want to achieve is sharp, sharp. As I sell you, you give me my money. It's like if you go and check for a supermarket, you will discover that as they sell, they pay immediately. If you go and look at the working capital cycle of a supermarket, that is why you will discover that when ShopRite came to Nigeria, the number of days it took them, or number of months it took them to become big is very small. Why? Because companies that want to sell through them will come to them and say, ShopRite, don't pay us. We will give you the stock. When you finish selling, you will give us the money. And you will see the receivable days for ShopRite is less than 1. Why? When you go and buy something, you pay them immediately. But you see, Friesland that is bringing their products inside the supermarket, ShopRite did not pay them. So effectively, ShopRite will not pay for the stock until they sell the products. They will now take remember, the selling price is higher than the amount they are supposed to pay back the supplier. They will now take their own profit and pay back the supplier. If you know anybody that is into supermarket business, it's a very good business. And that is why all of the likes of Amazon, it will always remain a profitable business. Because the payable days is long, receivable days is 0. We make money before we pay money. So to that extent, you would always remain profitable. So that is actually that. I want to believe I've answered your question. So you are correct. You asked the question, Titi Lion. You are correct. So basically, if you are in the service-oriented company, you don't have inventory. Your inventory is the people, and you cannot put the people in your balance sheet. It's only the people that are doing football, like Manchester United, that can put the money that they paid for signing. But you see, as a service-oriented company, your inventory days is effectively you don't have any inventory. So what you would have as your working capital cycle is your receivable and payable days. So that is, you are correct. So it is your receivable days minus your payable days. You are correct. Okay, so let's take it a step further. Titi, I want to believe you actually got the analysis. So let's leave. So I want, at every point in time, have these indices in your company. The indices, like I said, is your what? Working capital cycle. Let it be that rather than just looking at the financial statement, have an indices to help management your working capital cycle. Have it as part of the things you return to management on a monthly basis. So if your working capital cycle is small, you know that the company is what? Efficient. If your working capital is long, it means that your company is what? Inefficient. So you see companies where they pay for services immediately, they don't collect money on time, there's a problem. Not just, there's a big problem because their working capital cycle will be very long. And cash, they don't want to be cash trapped. And that is why if you have such a process, you need to speak with management to do the correcting. Okay, Olushesi, you said, are we getting the presentation slide? You will get the presentation slide. They will send you a mail at the end of this class. Everybody will get the presentation slide. There's no problem. Okay, taking it a step further. Okay, everybody is typing the question. Okay, wonderful. You can also talk. So let's take it a step further. So looking at financial position. So when I okay, another person is asking a question. Okay, no problem. I've seen your comment. Okay, financial position. Now, when I'm assessing the financial position of a company, I'm looking at the stability, the risk they are exposed to, the gearing. Should I shock you that not all borrowings is bad? Let me paint an example to you. You are in oil and gas, and you lift fuel or petrol from Sierra Leone to Nigeria. It will take 2 weeks for the vessel to leave Sierra Leone and get to Nigeria. And when it actually gets to the jetty, everything that you have inside the ship, there are off-takers that will buy it immediately in less than 2 days. If the return on that trip is, say, for example, 30% of what you're investing, and you can get a credit or you can borrow money at 10%, and you are very sure that you will be able to actually have off-takers, meaning between the time when you collect the loan or the borrowing and the time when you will collect your money is 2 weeks plus 2 days. Effectively, in 16 days, we have collected our money back. Then you can take a loan. Take a loan for about 16 days to 30 days, or just take a 1 month loan so that I don't take a 1 month loan. If you are sure that the interest can actually cover everything, then you can take a loan. But remember, when you are taking loan or you are bringing in leverage, be very careful. Ensure that the loan or the borrowing you are actually taking, the number of days for the working capital cycle is shorter. It has to be shorter. And the interest income that you, or the interest you will get, or the return you will get on the business is higher than the interest expense on the loan. Please, I want to believe you get me very well. Number one, the return on the business must be far higher than all of the total amount you would have to pay as your interest back to the bank, or your total cost. Far higher. Number two, the timing, your working capital cycle must be shorter than the number of the tenor of the borrowing you are taking. If it is not, you might need, that is where you begin to have a loan that you cannot pay back. Okay, what are the indices to measure organizational financial performance of services aside from revenue? Okay. Okay. Okay, I'll actually bring clarity to that too. So I'll bring clarity to that, Shiliola. So financial position actually looks at how you manage that gearing, how you manage it. So in a situation, for example, let me paint another example. You are into making ship. We make ship. To make one ship, it will take 1.5 years. Let us assume. Now you now went to the bank and took an overdraft. You went to the bank, took an overdraft, and you will be paying interest every blessed month, or a 1-month loan, or a 2-month loan. Now, and you know that the working capital cycle cannot be less than 2 months, because even to make the thing you want to sell is 1.5 years. Before they will pay you the money, total money back, is probably going to be another 3 months, 18 months. So your working capital cycle is probably between 18 months and 24 months. Then you went to take a loan of 2 months. Your interest expense will be higher. Your interest expense will be what? Far higher. Hence, your working capital cycle must be lower than your tenor for a loan, but not too, the difference must not be too much. You need to match it. That is why they call asset liability matching. You need to actually have asset liability what? Matching, to ensure that you are not paying in excess of what you should pay. Taking it a step further, let's now talk about some gearing ratios. Different gearing ratios. Debt equity. So your debt equity will measure the amount of debt versus the equity. The assumption is this: you can have companies that have, for example, in a situation where you actually took a loan just before year end, your debt will be so high as against the equity. Let's assume that you took so much loan. However, let's assume that a year after you paid everything back, or in 12 months, or just a little less than 12 months, you paid everything back. Why? Because you have been able to actually recoup the money, and you are able to actually pay the money out. The mere fact that you have a lot of debt as against equity is not a bad thing. However, your return on investment must be higher than your cost of capital. And when I mean cost of capital, I mean weighted average cost of capital, not just the cost of debt. Now, in other sessions after today, we'll be looking at how do you calculate weighted average cost of capital in real life. Cost of debt, very easy. Cost of capital, everything is there, but how do you calculate the cost? Because your cost of debt is very easy. The bank will give you your cost of debt. So in subsequent editions, we'll look at how do we calculate the weighted average cost of capital that we actually have. Okay. Taking it a step further, we can also use debt to capital employed. What does that measure? Debt to capital employed is saying within the total capital that you have used in this business, how much is the debt? Now, it is risky sometimes when you have, especially depending on now, what determines this is your working capital cycle. If your working capital cycle is less, is small, you can have debt in your equity. Oh, sorry, debt in your capital structure. But in a situation where your working capital is long, longer than the tenor of the leverage or the gearing, you are going to be making a loss. Also, you need to factor in the return on the investment as against the return, as against the cost of that capital. And when I'm looking at cost of capital, I'm looking at the cost of that debt and also the cost of what? Weighted average cost of capital for the whole business. So you need to actually compare. So we can also do debt to capital employed. What is this? All these things measuring is measuring how management is able to manage risk. The sincere truth is that it is not all risk that you take with your chest. If you see a business that you can use another person's chest to take it, put the other person's chest. As far as when the other person receives the thing, you also have a benefit from it. Meaning, it is not everything that you use shareholders' fund to fund. You can also use bank borrowing if the return on the investment is way higher than the cost of the debt. That is what I'm trying to actually explain. However, we need to be very careful too with the cost of servicing that particular debt. And when I'm talking about the cost of servicing that particular debt, that is where I come to interest coverage. Because the cost of servicing that debt is very critical. If your profit before interest and tax, and that is actually what profit before interest and tax over your interest expense, in a situation where the number of times that your interest expense is payable by your profit before interest and tax is not up to 1. That means that the business itself cannot pay for the interest expense. If it is multiple times the interest expense, that means the interest expense can be paid and we'll still have enough money for cost of equity, we'll still have enough money to do other things like paying bonus. So your interest coverage must be very high. Very high. And that is why it will help you to determine whether, so if you look at your interest coverage and you discover that, interest coverage is less than 1, it means that there's a problem. You need another cost of fund. Because you need, the people that, the bank you are owing, they will collect your asset if you cannot pay them. If they collect your asset, there's no business again. So very key indices that we actually need to look at. Let me just try to actually bring all the indices together so that basically we can just do a simple example. Okay, so somebody is asking a question. He says, what if the off-takers actually assured you that under 2 days, the goods will be exhausted, but came up with stories during the arrival? How else can you secure your investment even after taking loan? So remember, before you actually say, you need to actually have agreement with your off-takers. For example, before you actually even go ahead, get an LPO from your off-takers. Do your risk assessment properly from your off-takers. When I mean risk assessment, you know that, these people, they need this thing. They are in the business for it. If they don't get it, they won't be able to run business. You don't want to, for example, just be supplying, you say, it is my friend that wants to actually use it. However, he too is an agent that is trying to sell to another person. Have a direct contact with whoever the off-takers are that require it. Have a contract signed. Within the contract, let there be clauses that will say that at every point in time they will pay for this thing, even if they change their mind at any point in time. Put clauses within the warranty that will force the off-takers to take it. For example, if you go and look at the contract of Morino, you will see that they will always put it inside. If you sack the manager, you will pay him 2 years' salary. So before they sack the manager, they have to think twice. So also, you need to actually put clauses that will force them to ensure that they actually are put in, that they will either pay the full money or a percentage of the money, even when they decide that they are not going with you again. So, Mr. Daniel, I want to presume that I've answered the question that you have actually asked me. Okay, so let's go to another metric, which is the liquidity ratio. Now, you know some of this already. Current asset ratio. Current asset ratio is measuring basically current asset over current liabilities. And basically that is showing how many times can you pay your current liability with your current asset. How many times the assumption is that people that you are collecting short-term stocks from, you must be able to pay them when they're asking you for the money. If you cannot pay them, they might not believe you again. Oh. If they don't believe you again, trust is eroded. If trust is eroded, they will not do business with you again. If they're not doing business with you again, how will you get the inventory or the things that you're supposed to use to do business? So you want to ensure that you have a current asset, a current ratio that is multiple times your current liability. Then we also have the quick asset ratio. Quick asset ratio, very simple. Quick asset ratio is now saying, you see, within your current assets that you have, there are some of those current assets that are not readily convertible to cash. For example, inventory. Inventory is possible you have plenty inventory, you cannot sell it. So quick asset ratio is now saying it should be current asset, remove the inventory, divided by the current liability. If you can actually have multiple times your current liability in current asset minus the inventory, then you can run your business more efficiently. That is actually what the quick asset ratio is talking about. Now, taking it a step further, let us look at a real financial statement. Now, I'm going to show us a financial statement. The name of the company is Vine Limited. The name of the company is Vine Limited. I want us to take it as an example. And in about 10-15 minutes, we'll do all this ratio. Now, what I want us to do afterwards is now, when I'm done, I'm going to ask you to actually do the second part. Number one, tell me what the problem is in Vine Limited. I want us to be able to know what the problem is. So I'm going to show a financial statement that we're going to use in a couple of minutes. It's called Vine. The name of the company is Vine. Vine Limited. It's a wonderful company that I've been using, for example, for some years for these case studies. Now, Vine Limited is a beautiful company. Now, management wants to invest in them, the management of your company. They have given us the financial statement of financial position for 2014, 2013, 2012. They've also given us the P&L. They've given us statement of cash flows, all the full financial statement. Now, I want to actually do the analysis of these traditional ratios. Why? I want to be able to know what is going on in the company. So rather than reading the stories, I will do the ratios first. Then I will now use the stories in the financial statement to begin to buttress what I see in the analysis. If I go down to the end of the financial statement, I will begin to see 5-year financial statement summary. So I'm going to bring in the 5-year financial statement summary that I have. The 5-year financial statement summary here, I'm going to use Excel to do this example. So let me just open an Excel sheet. Like I always say, our training, so I have here P&L. So I'm going to copy P&L and put it here for Vine financial statement. This is the P&L for the 5 years. So I have it for 2014, 2013, 2012, 2011, and 2010. Now, I'm going to try to actually do this in 10 minutes or 15 minutes. I'll just try to actually do it as fast as possible because the class should end by 1. So I will try. So if I go now and I go and copy also the statement of financial position. So I'm actually doing this example like your normal companies. Okay, so I've heard that, Mr. Daniel. So let me just try to bring this very fast so that I can do some of the ratios and I can allow us to talk about it so that we can make it very. So the next one I put here is the statement of financial position. Statement of financial position. That is what I have here. Now I'm going to actually put all my ratios up here. So right here, I'm going to have all the ratios. So these are the years. So I copy the years here and I put them up here. So the first set we talked about were profitability ratios. Profitability ratios. Profitability ratios. Okay. So I've copied all of that. So for profitability ratios, we said profitability. We said we are going to use gross profit margin. And we said gross profit margin is what? I'm doing it immediately. We said gross profit margin is gross profit divided by, and I go away to go and look for the gross profit divided by total revenue. So if I drag that, this is telling me that this is the gross profit margin for all of this. So it's telling me these are the gross profit margins. Now, I also will use the net profit margin. Net profit margin is calculated as net profit. So I come here and I say profit for the period, which is a loss, divided by. Now I'm going to be using, I want to use profit before tax. So I put this one divided by what I have as the revenue. And I drag this understanding all out. So this is telling me that the net profit has always been a loss every blessed year. So the last one was return on capital employed. I said return on capital employed is measured as, so I'm going to use profit before tax, and I say profit before tax, and I say, can you see how simple it is? It's very simple. Divided by what I have as return on capital employed. My capital employed is the total shareholder fund plus the borrowing I have. So I drag that understanding, and it's telling me that it's even a loss that they are having all throughout. It's either a loss of 7, so for every 1 naira, I have 7 kobo. So let me leave it at, for every 1 naira, I have 7 kobo. For every 1 naira management invested, they got 7 kobo loss in 2014. In 2013, for every 1 naira they invested, they got 19 kobo loss. In 2012, for every 1 naira they invested, they got 1 kobo loss. So that is what, I'll just leave it at that point. Now, let me just go and just do some efficiency ratios. Now, the reason why I'm actually just trying to do some of this rather than look at all is because of our time. So efficiency ratios, let us bring the total working capital cycle. So I will start with the inventory days. Inventory days. Inventory days is measured as the inventory that I have. So I scroll down to where inventory is here, inventories, divided by what? Your inventories divided by what you have as cost of sales times 365. What this is telling us, okay, let me put this. So my cost of sales, because I put it from the, so this is 97 days. So I drag this, these are in days. So I come here and I have receivable days. Now for this example, now normally when I'm doing this receivable, I should have picked only trade receivables. Only trade receivables, not, because remember in my notes, I have many things inside receivable. But for this example, I'll just use the total here. So I'm going to have the receivable. So I go to receivable here, and the receivable here is telling me this is it. Now remember, inside this debtor and prepayment, I have more than debtors there. I should have been using the trade receivable alone, debtor alone. Please get me correctly. But I'm using this because of the time. So I should have gone to the notes and pick only the figure for the receivables, trade receivables, divided by what I have as sales. So I come here and I come and put it on sales times 365. So this thing is telling me that the receivable days is actually this. Now, payable days. Payable days is equals to what I have in trade payables. Like also, inside these trade payables that I have here, it includes all those withholding tax. It should not be part of it. Yeah, so you should have gone to the notes and pick only trade payables divided by what I have as cost of sales. And I can now multiply it by 365. Now, the meaning of this is that we are paying, okay, now that means that the working capital cycle is equals to inventory days plus receivable days minus what I have as payable days. Now, this is the number of days that we use. So this is the working capital cycle of the business. Now, is it getting better? Is it getting worse? Is the question that we now need to begin to ask to determine whether the business is efficient or not. So that is the efficiency ratio. Now, let me just do only for gearing so that I can just wrap up this class. Now, let us just do debt equity or debt over total capital employed. And debt over capital employed, I have some debt here. The debt I have here is this amount divided by the total of this amount plus what I have in shareholder fund. And if I drag that, that gives me this debt to equity. That means we have more debt in the capital employed than even the capital employed. Debt is, why? Because there's a loss inside there. Then coverage ratio. I'm just doing some of these ratios. Is equals to the interest expense, finance costs that we have divided by, the profit before interest and tax, which is this, divided by the amount that we have inside the finance cost. So if I do that, this thing is telling us that we cannot even pay for the finance cost. That is what it's telling us, that we cannot even pay for the finance cost. So that is what this is telling us. Now, if I may ask, I have done this, and I'm going to stop at these ratios I did, just the ones that you can see on your screen. I want to ask a question. My question now is that what is wrong with this company? Now, at this point, I want you to talk because we just have some minutes to wrap up. What do you think is wrong with this company? Hello? What is wrong with this company? At this point, I need everybody to talk, please. Hello? Now I want you to unmute. What is wrong with this company? Please, you can talk. You can talk, please. Okay. Yeah, I can see that you are typing, but I want some of us to talk too. What is wrong with this company? Somebody said it's not profitable. Yes, I know it's not profitable. Why are they not profitable? I'm not
Okay.
asking what is wrong with the company. I'm saying
Yes.
what is causing it? What is the root cause of their problem?
It's the return of capital employed.
Okay, you can go on, please. You can go on. Let's just go on,
It's
please.
negative.
Okay.
An average investor, we wouldn't like to invest in this company.
Okay. Why do you think their return on capital employed is negative?
Oh.
Okay. Somebody else. Okay. Any other contributions? What is wrong with this company?
The company.
You can go ahead. We can hear you. Kazim, you can go ahead, please.
Hello.
Yes, fire. Fire means talk.
Hello.
Fire.
Hello.
Talk.
Hello, this is Kazim.
Yes, fire.
Hello, this is Kazim.
Go ahead and
Yes,
talk.
the receivable days is far higher than the payable days. Receivable days is far higher than payable days.
Wonderful. So
that
what
means
should,
the company is taking a longer time to receive its own money from customers than paying to the suppliers.
Okay.
So they have to find a way to either reduce their receivable days or increase the payable days to suppliers. Though that may not be okay because the suppliers still need their funds.
Yes.
So they have to work on their receivable days
Mm. Mm.
to reduce it drastically.
So, as management, what would you suggest to management to do? With this, you said their working capital cycle is too effective, capital is too long. What would you suggest to management that they should do? Vivian, you raised your hand before. You can fire, please.
Yes, what I wanted to say is that the receivable days are far higher than the payable days. Because if the money they invested in the business, customers are holding on to the money, you know, and the payable days, they need to pay back their creditors. So they will have to go out to search for money to pay for their creditors while waiting for their debtors to pay them back. So they have to work on their receivable days, you know. Okay.
Oh, thank you very much. Okay. You are raising up your hand. So, Automat 23 is the name I see and I'm calling. You wanted to say something? Please go ahead. Automat 23, you raise up your hand. Go ahead, please.
Hello.
Yes, fire. Please go ahead.
Yeah. Okay. Looking at the performance of the organization, the gross profit margin, if you look at the trend, is increasing and dropping and increasing, which clearly shows that management has a lot to do on their direct cost to be able to stabilize the margin. So once they get the margin right, that will also tell on the net profit margin, because clearly they are making loss all through the years. They need to also check their operating costs too, aside the direct cost, so as to be making profits. And that is cascaded to return on capital employed too. That's why we're having negative return on capital employed all through the years, because they are not doing well in terms of managing their direct costs properly and their operating costs. And for the efficiency ratio, clearly the receivable days is too high. Their customers are holding on to their cash. So the days they are holding on to their cash is too high for the business. That they need to check their strategy to ensure that payments, their customer make their payment promptly, and the payable days, they need to renegotiate, to sit with their vendors or their supplier rather, so as to have a discussion with them to increase the payable days. At least 30, average of 30 days is still fine. Unlike what they're having for the year 2013, that they're having 6 days, and the current year, which is 24 days. So that's just a bit of what I can. And the company is highly geared. It's having
I was hearing
1.1.
somebody say they should go and take more money, more loan.
No. It's highly geared. The loan they are taking is too much. So they need to check that. So that's just a bit of contribution I have from my end.
Okay, thank you very much. I can see a lot of contributions chat. Okay, please. I want you to talk about it will be Tunde. I don't know the person that just spoke. Tunde Oluwadara, you raised your hand. You can go ahead and talk, please. Tunde Oluwadara, you raised your hand, really. Who else raised their hand? So,
hello.
Yes, you can go ahead, please.
All right. In order not to repeat what has been said before, okay. I think from the analysis, the company need to look at their overhead expenses, looking at the net profit margin, that is after overhead, is in loss, which means there are some expenses in their overhead which they also need to pay more attention to. And that can only be done by either increasing their income, revenue, or reducing some of the expenses.
Thank you very much. So let me now ask this second question.
Yes.
You are the new MD of this company. What would you do? So what would you do as the new MD of this company? And it's your course. You cannot throw it away. So I'm asking everybody, what would you do as the new MD of this company? What changes are you going to make? What policies are you going to make?
For me, if I'm appointed the new MD of the company, it's just to look for strategy to drive the sales and embark on cost-cutting technique to reduce the cost drastically, both the direct and indirect costs.
I thought, what would you do as the new MD of the company? Any other person, any other thoughts?
Hello.
Fire, please.
Yes.
Go ahead.
Hello.
Yes, go ahead.
All right. I think as the MD, one of the things that I will do is to review the credit policy.
Correct.
The credit policy of the organization, which gives creditors to pay money at their will. I think one of the things to do is to ensure that the number of receivable days come down, because if there is more money, there won't be need for that's why the debt in our balance sheet was accumulating, because there is no money and they need to service some of their payables. They need to pay them. So, and that is one of the reasons. So what I will do is to ensure that we review the credit policy of the organization, so as to ensure debtors, the trade debtors, pay up their money in due time.
Hello?
Yes, fire, please. Go ahead.
Okay. So if I'm the new managing director, what I will put in place is an efficient inventory controls, because the days of keeping inventory are kind of high, and that will result in maybe unnecessary storage costs.
Okay. Any other thought? Any other suggestions as we wrap this up? Because we'll continue next week. We'll be looking majorly at, now we have analyzed some of these financial statements. The question is, how do we ensure? We'll be looking at things around time value of money really. Next week, we'll be looking at how do we project, which are actually part of the things, since we now understand a little bit of understanding the financial statement the way it is. Now we'll be looking at some level of project analysis as assessment, appraisal. How do we appraise some of the projects that we are doing, whether they are even profitable? Since now we know the financial records and we can say these are the problems. Now, the sincere truth is that the problem with this company is plenty. Number one, is very geared. What is actually causing this net profit margin to be negative is actually the interest charge they are paying yearly. For example, the coverage ratio shows that even the profit before interest and tax cannot pay the interest expense. So the real problem, one of the major problems they are having, coverage is telling us that, is that the interest charge is so much that they cannot pay for it. So what do? They take more loan and more loan. However, if we are going to also send a sample of the financial statement to everybody to see the financial statement we are analyzing, you will discover that even the money that they took as a borrowing, they did not use it for the business because the asset is not increased. What did they use it for? So, number one.
Mr. Tunde, please change your mic. Can they hear you?
Okay, so let me try to. So, another one is that they need to actually reduce their leverage. Number two, this kind of company, to revamp it, they might need to actually bring in money. They might need to actually get the shareholders to be involved. Number three, a new policy needs to be drafted for receivable days. A new policy needs to be drafted for the payable days. Our receivable days cannot be grossly more than the payable days. Payable days must always be higher, so we need to drive down the receivable days. Number 4, we need to do better risk analysis at the point of registering the customers. Because we have a lot of customers that cannot pay for what they are buying. So better customer registration, better analysis on who the customers are at the point of registration. Probably to aid them to be able to pay better, they need to actually bring in policies like rebates that will drive rebates and discounts that will drive them to pay more. These are some of the things that as accountants, as finance people, you need to suggest to management. In summary or in conclusion, based on what we have done, the financial statement is telling us you can tell management what can make the company better. As line managers, as an employee, as a chartered accountant, if this is the company that you are actually preparing financial statement for, and you have not suggested to management such policies as this, then probably you are not doing the full scope of your work. You need to do better. Because if you are adding that value to the company will not allow you go. And they will increase whatever they will do to increase to make you better or to make you even stay. All I actually can say is that, you see, the financial health of your company is in your hand as an accountant, is in your hand as a finance person. At this point, I would like to bring this to a close for this session. And next week, we'll be continuing from this point. At this point, I would like to ask if there's any questions as I wrap up, because basically I'm done. Any questions as I wrap up before we begin to say thank yous and thank yous? Please, I want 1, 2, 3 people to talk before I move on. Questions, suggestions, or anything you want to say. I want to just be sure that I'm not the only one talking. Anything, final words. Please, everybody, you can talk. You can talk at this point. You can talk.
Hello.
Yes, go ahead and talk, please.
Please, when
Can you hear me?
The training next week, sir?
The training next week, they will send a mail to us, really. They will send it to us. I'm not 100% sure. They will send a mail to every one of us. And they will probably also send it as a chat. Another thing that will be done is that for everybody that has registered, please, for everybody that has registered, they would add you to a WhatsApp chat. If you would like them to add you to the WhatsApp chat, please just say yes in the chat, please. We just want in the WhatsApp chat, they will always send you like when it will be, so that there's no issues. They will always send you, and also on the WhatsApp chat, the link to the video for this will be sent. Beyond that, they will also send the materials for this training, so that there's coordination also for subsequent ones. Yeah. Okay.
Hello?
Automata, you can talk. Everybody, you can talk, Abeg.
Can you hear me, sir?
Fire, we can hear you.
Okay, so I also know that you have certificate courses and other training program. Can you and your team also work on reviewing the prices in the light of the economic situation everybody is facing?
Yes.
Because some of us are really interested in those programs.
Okay.
And we don't want to miss the opportunity. Thank you.
Okay, you're welcome. I will discuss with the team marketing team on that. Thank you very much. Any other concerns, please? I like that concern really, and it's taking. Okay.
I like that too.
Okay. Any other thoughts before we wrap up for today? I'd like to say thank you to everybody for joining. I want to believe that it's been educative and you've had fun. Thank you very much for joining and have fun. Thank you. And bye-bye.
Thank you.
Okay.
Bye.
Thank you.
Please, everybody raising up your hand. You can talk. Oh.
Thank you.
Okay.
Thank you for the training.
Okay, thank you very much.
Thank you.
Thank you very much. Thank you very much.
Thank you, sir. God bless you.
Don't worry, they will add everybody to the WhatsApp chat. They will just add, no problem. Thank you very much. Have fun and have a lovely day. Okay, bye.
Thanks.
Tunde Oluwadara, have you talked? Because I can see that you are raising up your hand, really. Hope you are not. Okay, I want to assume that.
CP.
Yeah? You heard your voice.
Are you serious?
Yes.
Eh.
Thank you. And you almost are on my